Good morning, one and all. Welcome to the subject of direct taxes at the finals level. So, till now, we have been discussing, we all were connected for the subject of indirect tax. Now, from today, we will be discussing on this a very different approach than GST or indirect tax that you will understand and observe when we are dealing with this subject of direct tax. But now, since what is there in front of us is what you all have already studied at interest level, and definitely capital gain is such a thing which I am sure you all would have some insights. I'm not saying you all are very much abreast with all the amendments, that is fine, but at least you all are into the topic of capital gain. So I will request that let us make this topic more interactive, more value adding by sharing practical insights, whatever you have, and also wherever you feel that there is any practical case scenario in front of you which is related to that relevant topic, that related provision, definitely we should take it up. So, good evening, everyone, and let us start with this topic. Now, if you remember, I had given you an approach in case of GST. What was the approach? You first check whether there is a transaction. Second, whether the transaction fits in the definition of supply and how to analyze supply. Again, there were sub points. And then you will see whether it is exempt. If not exempt, then only you will proceed to determine the other things like place of supply and then the nature of supply and everything else. Similarly, there is an approach even when you come to the subject of direct tax. Now, see, when you're at final level, you should always think from the perspective of a case study approach type of a question. So, at final level, it is not that it will be a simple, straightforward question where you are only computing the income or tax liability, or you are simply saying yes or no for any type of question. Here, you'll have to think from a multiple, you can say, domain, because at final level the question may not be as simple and as straight as ki, okay, compute capital gain or compute the PGBP income. Here at final level, firstly, the question may at the same time address different heads. Secondly, the question at the same time may require you to think from the perspective of company law, to think from the perspective of GST law, because whenever you are taking any tax position, you cannot advise a tax position ignoring the impact on other laws, because you may advise a position of tax which will give them favorable tax as far as income tax is concerned, but if that is something which is not allowed by the company's law, then that advice is futile. So whenever you are going to give any opinion advice here, because at final level in a question they always ask you many times that, okay, give your opinion, give your advice, or how you can reduce the tax liability. So you have to give your suggestions. For those type of questions, it is very important, students, that you also keep in mind the implication of parallel laws. Now, when we are in the topic of capital gain, let me again give you an approach. I'm drawing the approach, I'm writing the approach here, so that because this chapter, as we will proceed, I'll be adding something in each of these points. Now, again, before you start computing income, the first thing is you have to check whether there is income. Correct? Now, income basically will be obviously if there are some receipts, right? And those receipts you have earned by doing something. Now, that doing something may be by giving your efforts in the form of mental labor, physical labor, or by giving some of your assets to somebody else to use, or by investing your time, money into some activity. Now, when any of these things are there, then only that receipt can be termed as income, or that receipt falls in the category of something which you have earned. But besides this, as you know, अरे तुमने बंद कर दिया क्या कुछ दीपा? Students, is my net on? Because suddenly everything is off. Am I audible and visible to all? मुझे क्यों नहीं कुछ दिख रहा है, फिर आप लोग क्यों नहीं दिख रहे? One second. ठीक. Now, besides the real incomes, I call these as your real incomes. है ना, वही कुछ तो मेरे यहाँ पे भी अटक गया, मेरे यहाँ पे सब ब्लैंक आउट हो गया, जो मेरे को सामने मेरा खुद का वीडियो दिखता है वो सब एकदम बंद हो गया, मुझे लगा शायद नेट चला गया. ओके, ठीक है. नाउ, so students, whenever you are handling a matter of income tax, your first approach should be to check whether there is income. Income means real incomes where there is a receipt and it is falling in the category of earning. And what will be earning? Where, so I'll do it like this, where there is give and take. So what will be earning? Earning is where you have given something, your physical, mental labor, or some of your assets to someone, or you have put in your efforts, you have taken a risk. All these things will lead to earning. Then you have something which I call as deemed incomes. Deemed income means those cases where this earning is absent. Why? Because there is no quid pro quo necessarily. Now, you will say, sir, what are the examples of this? Then the examples of this are winnings. The examples of this are gifts. And there are so many things which will fall in this list where the basic element of income, that is earning, is missing. But again, they have to be taxed. Why? Because the law provides for taxing them as income. All these are covered under the definition of income under Section 2, Clause 24 of the Income Tax Act 1961. After some time, it would be Income Tax Act 2025 that would be studying. But right now, what we are studying is Income Tax Act 1961. सर, मेरा कुछ वीडियो अटक रहा है, ऐसा कुछ हो रहा है क्या? Ashok ji or students, is there some problem with my audio video?
No, it's okay, sir. It's okay.
मेरे यहाँ पे कुछ बार बार ऐसा लग रहा है जैसे अटक रहा है. One second.
Sir, there is some internet issue from your side, I think.
हाँ, that is what I feel, क्योंकि मुझे भी वैसा लग रहा है. ठीक है
सर,
सर.
एक बार बैंडविड्थ चेक कर लीजिए.
हाँ सर, ठीक. Okay. Now, so students, first step in any income tax case scenario is first checking whether there is income, either real or deemed. Now, once there is income, the next step is to again check the exemption, which is under Section 10 of the present Income Tax Act. You have to check whether or not your case is exempt, right? Now comes the most important point. When we talk about income, and let us say it is not exempt under Section 10, it means finally your income is a taxable income. Now comes the most important point, that is heads. Presently, the law says that whatever income is taxable to you, that income has to be classified into 5 heads or categories, as we all know. I'm using the abbreviations because I'm sure at final level you all are knowing the abbreviations. Okay, just to add before, if anybody wants to just more detail it, that once there is an income, you can say there is a mid step also. You have to check whether this income is a total income as per Section 5. Total income depends upon your residential status, because it may happen that some income may not be taxable to you because of the residential status that you hold. So that is one, you can say, a midway thing that you should check. So first, whether there is income. Second, whether that income falls in your total income as per section 5, which has to be read with section 6, that is your residential status provisions. And if it is fitting in your total income, then you will go to proceed to check exemption list. If it is not falling in exemption list, it is taxable. And then you have to bifurcate it into heads. Now, interestingly, which section tells you that the income has to be computed in heads? That is section 14. So section 14 tells you that income is to be computed in heads, and then each head comprises of few sections. So from section 15 onwards, you have salary up to 17. Then from section 22 to 27 is HP, 28 to 44 is PGBP, 45 to 55 is CG, and 56 to 59 is other sources. Then within this, there is one more category which we normally refer to as clubbing, right? Where the Act never uses this term. The Act uses the term income of some other person to be included in the total income of the assessee. This is what the Act uses the term. So you have to check whether any such income which is earned by somebody else, which is accruing to somebody else, has to be taxed to you. If yes, that shall also be included in your total income. And that is from section 60 to, let us say, 69. Now, out of this, right now, we are focused on only one topic today, that is capital gains. But just I thought I'll give you an approach as to how you proceed to analyze any case study that you'll get under the income tax subject or the direct tax subject, that you should first always start checking with income. Don't presume anything that yes, okay, if it is at CA final, it means they are expecting you to solve and compute. Not necessary. At times, it may also happen that your answer can be as simple as this is not income, hence no question of tax. Or your answer can be as simple as though this is income, as per section 5, it is not falling in the total income definition applicable to me as per my residential status, hence not taxable. So it is not that the data, whatever is given, will always lead to computation, because there is a possibility. Now, once you are through with the steps, now we come to computation part and the other detailings relating to every head. Now, the first most question, once section 14 tells me, boss, whatever is your total income, you have to first classify it into the 5 heads and then proceed. The most important point is, I'm sure by now you all would be knowing, being cleared the interlevel and knowing the interlevel, that one second again, I think there is some problem. Sir, my screen is visible to you all. Is it? Yeah, it is moving now. Yeah. Perfect. Now, one section 14 has asked me to do computation headwise. The question is why? The answer is very simple, because if you observe, if you remember your interlevel, you will know that every head has a different approach of computation. By approach, what I mean, a particular expense, like if you look after the head of house property, there is no deduction for all expenses. There is a very limited deduction. The limited deduction is only limited to 3 expenses, and then you have a standard deduction. That's it. But when you go to PGBP and other sources, all expenses can be deducted unless it is otherwise restricted. So see the difference in computation. Plus, different heads have different exemptions. So because the law wanted to provide for a different mechanism relating to every head or every source, they asked you to categorize it into heads. In fact, even if you remember, we have the topic of set off and carry forward of losses, again you will find that the sections for carry forward and set off are providing for different rules for different heads. It means that there is no such thing that all losses will be treated in the same fashion. Some may be allowed to be set off with the other heads, some may not be allowed, some may be allowed to be carried forward for 4 years, some for 8 years, and so on. Now, because of all this, the scenario is that classification into heads becomes very, very, very important, right? Now comes the most important point. Here, I would request you all to unmute and answer me. How will you decide that if, let us say, you have 6 different sources of incomes, 1, 2, 3, 4, 5, 6, which source will fall under which head?
Each source has charging section into it.
Sorry, 1 second. Yes, can you please repeat, Yogesh ji?
चार्जिंग सेक्शन रहता है हर एक सेक्शन में which
हाँ,
says that
correct.
it will be followed to the head of income.
Perfect. So Yogesh has pointed out very important thing that every head has a charging section. Now my question to everyone, ki which is that charging section? Which is that charging section, students? You all said
45
correct.
for capital gains.
Okay. And
28 for PGBP.
28 for PGBP. Okay.
Salary 15.
So simple, Yogesh, simple.
15, 22, 28, 45, 56.
It means the first section of every head is the charging section. Correct? Students, I want your involvement because what I'm explaining is something very, very crucial. Because this point will create a big difference in understanding and later on in solving and even in your professional practice. So when you're talking about computation, you have to be clear that you should be thorough with the first section of every head. Because other computation point will follow. Like I'll give you an example. There is interest on investment. Now, which head this interest will fall? This interest can fall in other sources. This interest can also fall in PGBP. There is a possibility that this interest can fall in 2 of the heads. Similarly, if one of your incomes is rental income, it may fall in 3 heads. Are you getting this? So the point that you have to understand and remember and apply is that only by the name of a particular thing, you cannot say that it will fall or not fall in a particular case. And that is where the first section of every head becomes very, very crucial. Correct? So as rightly pointed out by Yogesh, the first section will decide as to under which head your income would be classifiable. Right? Any questions? Just a minute. Now I ask you another question. Now I want your inputs. Now you have a capital receipt. First interesting point to be noted is here when we talked about receipts, which I said are taxable, we all know receipts are of 2 types. Being a student from accounting, we know that receipts can be a revenue receipt or a receipt can be a capital receipt. Now, what is a capital receipt? If I have to put it in very simple plain terms, a capital receipt is a receipt against sacrifice of source of income. If I have to give you a very broad answer to capital receipt is that receipt which you get against sacrifice of source of income. So whatever is source of income, that if it is sacrificed, if it is foregone, if it is sold, if it is transferred, that leads to a capital receipt. Right? Now, or another interesting way, whatever is not a revenue receipt, because then that is also correct. Capital receipt can be much broad. It cannot only be from transfer of capital asset. What is normal understanding that only from transfer of capital asset there is capital receipt? No, not necessary. So I widened it by saying by sacrificing source. And now further I'm widening it by saying anything which is not a revenue receipt is capital. Perfect. Now my main question. Under which head capital receipt would be taxed?
Capital gains. Income
Okay.
of capital gains.
Sir.
Not always, even in PGBP also there are some capitals.
Be assured, at this level, maybe my question to my answers will not be so straight. So you can always expect that if I'm asking you a very basic question, the answer, what comes to your mind first, will not be the complete answer. I'm not saying it is wrong. It may not be the complete answer, right? So yes, Yogesh, you're right. In fact, somebody else, I was just checking in the chat also, Chitra, yes. More what Geet said, I am not getting unless specifically charged to PGBP. Geet, what do you mean by this? Should I tell you, except HP, you will find all heads except HP covering capital receipts. Is it correct? I am saying all heads except HP covers capital receipts. Chalo, students, I want you all to be interactive. I've said, I've made a statement, an assertive statement, which till now you all were not, you had not given me this answer. Somebody said only CG, somebody said PGBP CG. I'm saying much beyond that. And
The income from other source also is there. There is a capital receipts.
so I'm saying, sir, every head except HP. This is what is my answer. So it means even salary, even
salary,
PGBP. Yes.
Salary, I have doubts, sir.
So this is why I'm waiting, sir. I am waiting because I want you all to argue with me. Don't accept what I'm saying because that will not add to your knowledge.
For a salary, there should be an employee-employee relationship. So where?
See, firstly, anything under employer-employee relationship goes to salary, correct?
Yes. Sir.
Now your query is, sir, how can there be a capital receipt under salary? Or I'm saying there is a capital receipt, but you are saying, sir, which one? Correct?
Yes, sir.
Chalo, anybody can help me answer Yogesh question. Yes. I'll give you a very small example.
Any asset transferred by the employer. Any asset transferred by the employer.
No. Sanjay, sorry. Asset transferred by employee will never be covered. Because that is not under employer-employee relationship. See, firstly, to be covered under salary, it has to be employer-employee relationship. Na?
As a perquisite.
But perquisites are then revenue receipts. Yes.
Voluntary retirement.
Do you get VRS?
Yes, sir.
and it is taxed under the head salary. It is a capital receipt because it is again sacrifice of your job. You get retrenchment compensation. It is again sacrifice of your job. If you see gratuity, the working of gratuity, it is based on multiple years of service. So it is not pertaining to 1 year. See, generally revenue is something which is pertaining to 1 year. So many of these are capital receipts, but covered under salary. PGBP also we have some capital receipts like the non-compete fees, the simplest example. There are multiple, but I'm giving the most basic one. Other sources has so many capital receipts. Correct? So first thing what I want to clarify from this discussion is not every capital receipt is capital gain. Please be clear. Also, what I've written here, see, it is not necessary that every capital receipt is taxable. There could be a possibility that some capital receipts are non-taxable. Why? Because they do not fit into the definition of income itself. Why I am saying this? Because as far as my understanding is, 90% of students believe that once it is a capital receipt, it has to go to capital gains, or at least it has to be taxed. Please be clear, students, because at final level, these things are very important. Because as I said, your case study questions many times are targeting the levy itself. So within capital receipts, there could be capital receipts which are non-taxable at all. Nowhere it is covered in the definition of income. So it cannot be taxed. And that is why I said first check whether it is an income. If it is not income as per 224, be it revenue receipt, capital receipt, it will not be taxed. But if I'm particular about capital receipt, a misconception I'm trying to bust that every capital receipt will be taxed. And majorly people think every capital receipt is capital gain. So first, most important thing I want to bring to light is this. Not every capital receipt is capital gain. I already proved that. We have multiple capital receipt being taxed under other heads also. And most important thing, not every capital receipt is taxable. Again, another myth that if something is not taxable under the four heads, by default, it will come in the dustbin because other sources is a dustbin, it will cover everything. Sorry, that is again a myth. Please don't give your conclusion ki acha, if you're not finding it fitting in business head or capital head or other any head, chalo, it will be taxed in other sources. No, don't be under that presumption. I hope I'm clear. So, capital receipt may not be taxable at all. Why? It is not fitting in 224. And if it is taxable, it can be taxed in any of the four heads. So except HP, it can be taxed. So what I'm trying to make out, a final conclusion is not every capital receipt is capital gain. It means in order to be capital gain, there has to be something very specific. In order to be taxed under the head capital gain, there has to be something very specific. It cannot simply be a capital receipt and it will be taxed. Sorry, not possible, not correct. Right?
Right.
Now the question comes, is sir, up till now we were of the understanding impression that every capital receipt is capital gain, but now suddenly you are justifying. So now we are having another question. Then which capital receipt will be capital gain? How will I identify? The answer is what I already asked a question for which the answer was you have to refer to the charging section of every head. Until unless something is covered in the charging section, correct, Megha, it will not be taxed. Now, I use a word generally. I'll be giving you some rules. I'll be giving you some principles how you can understand, remember capital gains chapter, because capital gain chapter is something very different from other chapters, right? So my first rule is capital gain is an exceptional head of income. HOI is head of income. This is my first rule or first principle about this topic. What did I say? Capital gain is an exceptional head of income. Why am I saying this? Many reasons. Reason number one, it is such an head of income where the moment you say something, remember there has to be exception. Means there is no provision in this chapter, in this head, which is without an exception. So interestingly, you will find that whatever we are discussing, if I give you a rule, if I give you a provision, remember there will be exceptions. So first reason why I'm saying this head is an exceptional head of income, because it is such an head of income where you will find exception to everything that you will study in this chapter. Second reason why I'm calling it as exceptional head. All other heads, salary, HP, PGBP, other sources have only one charging section. This is such an head which has multiple charging sections. This is again interesting. So again, this is an exceptional head because other heads have only one charging section. This head has multiple charging sections. Correct? Fine, na? So this is some basic. Before I launch this chapter, I thought I'll make the air clear for everyone so that we are on the same page. Now, if anybody has any discussion to be made, any argument to be made, any questions to be raised, I give you a minute. We can first take up your discussion pointers, your arguments, and then we will proceed. Yes, anybody wants to ask anything, add something, I'm open. Students, I'm open to your pointers. No pointers? Everything
No,
fine?
it's okay, sir. Yeah, it's okay, sir. Learned something
Okay.
new today.
Sorry?
Learn something new.
Okay.
Actually,
Tell me, please. Please interact. Yes, tell me.
yeah, I learned a lot today, actually.
Okay,
Learned a
fine.
lot.
Okay. Sir, it is still hardly 15 minutes we have been into this topic, right? Don't
Yeah.
worry. This is my favorite topic of income tax. I should say one of the most favorite topics in all the topics or in all the subjects that I work in. The reason is it adds lot of value, lot of understanding, and most important, it gives you a different approach, a different line of thinking, which helps you in other topics also. So this is one of my favorites. Okay,
Okay.
great. So students, with this backdrop, let me give you the approach for studying, learning, remembering, and even applying this topic in your exams and later on in your profession. First, most important point is the sequence in which you have to study, apply this topic. First, charging section. Because as I said, not all capital receipts are capital gains. So before I start doing anything in this topic, I need to first finalize whether I fit in this topic and who will help me finalize the charging section. Now, for the time being, we all know the charging section is 45.1, not entire 45, it is only 45.1. But I've already informed you there are multiple charging sections, more than one we will come across. So I'll keep on adding in this list. But for the time being, we will go in the manner in which you know this topic or this chapter, correct? So for the time being, I will say there is only one charging section, as we all know. but I will keep on adding to this as we come across those sections. Rather, now I'll give you a very interesting homework. You may run through the entire chapter, may not be details of every section, at least the headings of every section. And you can come back to me in the next lecture telling me, informing me, sir, yes, these are those charging sections besides 45.1. So there are multiple charging sections. First, 45.1. Now, since 45.1 is the major charging section, others are very specific, made for a very particular case scenario. So if we go ahead with this charging section, that is 45.1, you find that the charging section has some requirements. What would be taxed under this charging section requires that there has to be a capital asset. The capital asset is transferred. So I'll use the word transfer. So the first two things that you will check is whether the asset is a capital asset. Second, whether this capital asset is transferred. Now, once both these criterions are satisfied, so you can say you fit in the charging section. However, you have to exclude from this those cases which are exempt under section 10. After this, what is left is what is the taxable capital gains. Like how above I was writing taxable income, now I'm writing taxable capital gains. Now, once a particular transaction is a taxable capital gain, you proceed to compute the income and later on the tax. For this, the first thing that has to be checked is the year of chargeability. Now, this is also going to be an interesting discussion. Then the full value of consideration, the expenses on transfer, the cost of acquisition, the cost of improvement, indexation, then deduction under section 54, and finally will come the tax rates on capital gain. I'm sure you all would remember that capital gain has special tax rates. The regular slab rates are not applicable except for one capital gain. Others, it is not applicable. So when we have to study this chapter, our sequence should be first check whether you fit in charging section. For the time being, it is 45.1. Then to fit under 45.1, the two basic requirements are there should be a capital asset and the asset is to be transferred. And if both these criterions are satisfied, before you launch yourself on computation, you have to first ensure that your case is not covered under section 10. If not covered, it means your case is taxable. So now you can launch the most favorite thing, that is the computation. And for computation, you have to determine all these things independently. After determining all these things, you reach the figure of capital gain or capital loss. If it is capital loss, the point for the timing is over. You have to only check for the set of provisions, whether you can set it off or you have to carry forward. If it is capital gains, you will check whether I can reduce the capital gain and the tax liability by reinvesting it somewhere, which is your deduction under section 54. And after that, what is left is the final taxable capital gain, for which you have to check, is there a special tax rate? This is the whole sequence, whole approach to this chapter. I will try to take you to this whole chapter in this sequence only. At times we may switch from one part to another part, but otherwise I'll try to follow this sequence. One thing pending from your end is, I want you all to give me the other parallel charging sections. that if possible, you can give me by the end of today's lecture. If in between you can check, or whenever you can give me maximum by next lecture. One very important thing. This thing you can write down even in your notebooks. Because see, a common challenge which students always put across to me when I teach them 2 chapters or other 4 chapters, but majorly 2 out of the head, that is capital gain and then PGBPs. Sir, how do we remember the section numbers? This is a bigger challenge in capital gain because capital gain has more than 50 sections to be studied. Though number-wise it is 45 to 55, but if you recall, there are many subsections, 45(1)A, 45(5)A, 50C, 50D, 49, 49AA, so many. So many times the students face a challenge of, sir, how to remember so many section numbers. What I used to do is, I used to make a list of section numbers covered in that chapter in that particular topic. And once I understood capital gain and I started teaching, I developed this sequence that when I have to write down section numbers, let me write down in relation to the provisions or in relation to these pointers on the basis of which I'm going to study and also apply capital gains. So I will request that you should make a parallel notebook where you'll write down the same sequence. And as we proceed with the chapter, you will start adding these section numbers here. So this would be a quick referencer for learning, remembering, and even revising section numbers on last date. And then further chapters, further pages in your same notebook would be each of these points then dealt in detail. So this can be a summary with section numbers, and then every page henceforth would be the detailed page. Fine. Okay. So now let us start with the first part. Charging section, which is for the time being the main charging section, 45(1). See, I've opened the act also. So wherever we feel that we need to refer to the act, we will be referring to the act, because I always find more comfort in reading the bare act than reading other details. Sorry, yeah. So let me start with the charging section first. Students, do help me with the page numbers. Yeah. Now, what does the charging section says? Chalo, can someone help me with the reading as we do in our GST topic also? Students, anybody would help me with the reading, please? Yes, anybody?
Yes, sir.
Yogesh. Yeah.
Yeah.
45.
Section 45(1). Any profits or gain arising from the transfer of capital asset affected in the previous year shall, save as otherwise provided in section 54, 54B, 54D, 54E, 54EA, 54EB, 54F, 54G, and 54H, be chargeable to income tax under the head capital gain and shall be deemed to be the income of the previous year in which the transfer took place.
Okay, super. Right now, we are only concerned with subsection 1 because subsection 1 is the main charging section. All other subsections, as you can see on the screen, that is not relevant right now. So We want to understand what would be taxed under this head. It starts with the term profits or gains. Now remember students, profits also include and means negative profits, and hence even losses are covered. Because a question may come to someone, sir, then what about capital losses? Will it not be covered under this head? By default, it will be covered under this head, because when the term profit is used, need not use the word loss. Loss is complementary to profit. Loss is a negative profit. So whenever profits are used, it means even losses are covered. Now, what is more important is what type of profits or gains are covered? This part. This is the key point of this particular topic, of this particular, rather I'll say section, that only strictly limited to this. What? Profits which are arising from transfer of a capital asset. That is why I gave you only 2 pointers in my sequence, that what 45 requires for being covered under this head is only 2 things. 1, there is a capital asset. 2, the capital asset is transferred. And then it further says effected in the previous year shall. Now see, as I said, whatever you study in this chapter, every provision has some exception. You will find that the charging section is no exception to this rule of mine. Even the charging section has an exception. What it says? Save as otherwise provided. Now, student, just something beyond taxation or income tax. This is a common phrase used in laws, in legal draftings. What does this phrase means? Save as otherwise provided. It means except if something opposite is given. It means the rule that it will be taxed or you have to pay tax has an exception. This is what the charging section itself is saying. And the exceptions are those deductions, or many times we call it as exemptions, which are given under these sections. Now, I'm sure students, you all know what these sections are. So if I have a capital gain, law provides me an opportunity to save tax by reinvesting, subject to some conditions and restrictions, time limits, etc. But that is one of the scopes given. But that part right now I'm not considering. So for me, what is important? Profits are arising from transfer of capital asset. The transfer has effected in the previous year. So in a particular previous year, the transfer took place. This profit shall be chargeable to income tax under this head. That is the capital gain head. And it shall be deemed to be the income of the previous year in which transfer took place. So the general rule of year of chargeability is year of chargeability as per section 45(1). General rule is what is year of transfer. So 45(1) itself says you will tax this particular capital gain in the year in which transfer took place. So the year of chargeability, general rule, but I repeat, I have given you first principle of this chapter, that capital gain is an exceptional head. This is my first principle of this chapter, which means whatever you read, everything has to have an exception. So whatever we are discussing, you will find exception to everything. So right now I'm discussing the charging section. Key points coming out from charging section is there is a capital asset. The capital asset is transferred and it shall be taxed in year of transfer. Correct? Can I say these are the basic things coming out of this? And then it says there are some exceptions in the form of section 54 provisions. So this is very briefly, I have summarized the charging section. So now I need to first test my chargeability key, whether my transaction is chargeable, whether I should proceed reading this chapter or I should go to any other chapter, any other head. For this, we have to check 2 requirements. 1, is there a capital asset? 2, is the capital asset transferred? So now let me take you to the first thing which I would like to discuss, that is the definition of transfer. So we will first start discussing transfer and then we will proceed to discuss capital asset maybe after 1.5 hours, whenever this point gets over. So again, please read.
Transfer, Section 2, Clause 47. The Act contains an inclusive definition of the term transfer. Accordingly, transfer in relation to a capital asset includes the following type of transactions: the sale, exchange, or relinquishment of an asset, or
Just wait. I want to highlight something. What is very interesting, given in section 2, clause 47, the definition of transfer, it starts with this: transfer in relation to capital asset. Means what? This definition of transfer is not generic. This definition of transfer you cannot apply to any other thing except a capital asset, and indirectly you also can conclude that this definition is restricted only to capital gain, because only capital gain covers the concept of transfer of capital asset. So see, you will find that there are some definitions which are having limited application. This is one such definition. So transfer may mean something else also, but when it is to be applied in relation to capital asset, or I will go a step further saying, when it is applied for determining capital gains, it will include the following types of transactions. Correct? Now, the second interesting point to note is this definition says it will include, means the definition, the concept is not exhaustive. There are two types of definitions broadly in any law. One is inclusive, one is exhaustive. Exhaustive definition will read transfer means. So wherever the term means is used, or it says by way of, like when you read GST law, many times like healthcare service means service by way of. So it is making it very specific, very restrictive. But wherever it says includes, means what? Besides what is transfer in general, it will further include these things. It means the animal called as transfer is much, much bigger. It is like this. I am defining elephant. I say elephant includes 2 legs, 4 legs, sorry, a trunk, 2 big ears, a tail. Now I am only defining elephant in terms of what it includes and not what it is wholly. So what I have not defined will also be elephant if in general it is part of elephant, like a trunk. Let us say I have not defined or not covered trunk in my definition. In this list, I have not covered trunk. But we all know elephant has a trunk. So whenever it will come to trunk, you will obviously mean that yes, it is elephant only. So this is also what you need to remember and understand, that this definition is not final. And I will prove it when we go to some special transactions, because in every transaction we'll study, I will ask you to test whether there is transfer, whether there is capital asset. At that time, you'll realize that whatever you are studying here, the list, some of the transactions are such they are not fitting in the list, but still they are transfer. Why? Because this definition is not exhaustive. This definition is not conclusive. This definition is not complete. I hope this is clear. Okay? Let us read the list, and let us not read it completely. We'll discuss each clause items one by one. So please read the first clause.
sale, exchange, or relinquishment of the asset.
Okay. So the first clause itself covers 3 line items. It says transfer will be sale, transfer will be exchange, and transfer will be relinquishment of asset. Now, I think everybody of us present here understands the first two things, sale and exchange, because they are very common, very generic things. So I'm not discussing much. And also there is no specific definition given in the act for these. But I think something new, something different for y'all is the concept of relinquishment of asset. So my question to y'all is, can anybody of you help me understand what is relinquishment of asset?
Parting away from the rights on the asset.
Give me some example, because you're correct, but this is too technical for me to understand as a layman.
If I have a right to use something, some asset, but I am giving it away. the right to use some asset. That is means मैं उस asset पे अपना rights दे रहा हूँ पूरा का पूरा.
Will it not fall in the second clause? Just check.
Extinguishment of any extinguishment is
When you are saying you are giving away the right in the asset, will it not fall there?
extinguishment is destroying मतलब completely giving up the asset something kind. मतलब asset कोई
और
बेच देना.
तो वो वही तो relinquishment है ना.
Okay.
Extinguish. See, this is what I'm trying to highlight. See, students, please, I want to inculcate a very important habit in you all, that is of reading the provisions minutely. And this applies here very much because you will see the difference. What it says, relinquishment, chalo, relinquishment word jane do, of the asset. Whereas here says of rights therein means in the asset. So when you're talking about rights in the asset, it is in fact the second clause. And when you are talking ki asset hi maine de diya, then it is the first clause. In fact, now see, there is a concept adjustum generis. It is a Latin term, which means that when you are reading a provision and something, some word is like any other, etc., how you have to interpret such open-ended words on the basis of the specific words used. On that lines, if you see, when you read sale exchange is also of the asset, not of the rights in the asset. And relinquishment, that is why these three words are kept together. So in all these three things, what is happening in all these three things, the entire asset is going. Whereas why this is kept separately? See, had it been of the same nature, they could have added the fourth word here also, na, sale, exchange, relinquishment, extinguishment. But it is not about extinguishment of asset. In fact, now I'm pointing out one thing from all this discussion. Here. Now, what impact it has, that you will get to know when you read the other charging section whenever we reach there, 45 bracket 1a. Extinguishment of asset is not a transfer here. Now coming back to our discussion point, relinquishment of asset is giving away the asset. To relinquish means to give away. But what? Not the rights, the asset itself. The asset itself. Example, gift. When you gift an asset, have you sold the asset? Answer is no. Have you exchanged the asset? The answer is no. Then what you have done? You have relinquished the asset. I hope you are getting my point.
Yes,
Students,
sir.
I hope my point is clear to you all. So, when I'm saying relinquishment, it means parting away with the asset itself, not the right. Yes, Geet, you're right. Even disposal of asset is covered here because you are parting away with the asset. So, relinquishment is parting with the asset itself. Then comes this point, which is extinguishment. And I just highlighted it is not of the asset. Extinguishment of asset is not a transfer, not covered here. So, extinguishment of asset will not be taxed, at least here. I'm not saying it will not be taxed at all. That we have to still see. And there, I already mentioned, we already have another provision where it can be covered, obviously subject to the provisions of that particular section, that is 45 bracket 1a. But at least here, the present point which we are discussing, it is not covered. Now, somebody will ask, sir, then what will be covered here? I'll give you a very simple example of extinguishment of rights in the asset, not the asset. The example is that, let us say I have a joint property. In this joint property, we have three brothers who have got this property by inheritance. Now, that is a common single flat in which all three are staying. Now, I cannot sell the flat to my brothers because they are also staying in the same flat. They are also having some rights in the flat. There is no demarcation possible, physical demarcation that, okay, this much part of the flat is mine, this much is yours, this much is of the third brother. Not possible. What are we doing is, or if I have to get out of this, what I will say, I will make an agreement whereby whatever is my share in this flat, share in the ownership rights of this flat, that share I'm giving away or I'm putting an end to. So the point is, extinguishing the right means putting an end to my right in the asset. The simplest example I gave. I hope it is clear. And now you are able to distinguish between the two pointers. Students.
Yes, sir.
Yes, sir. Got
Any
it.
doubts? Perfect. Now coming to the third interesting point, compulsory acquisition thereof. Thereof means of the asset. And again, it is further adding. It should be under any law. Now here I have two very important inputs. What was the need to put compulsory acquisition separately? Because it is not covered in above. Please understand and appreciate one thing, students. Compulsory acquisition is a unilateral act. Unilateral means maybe you are not allowing your asset to be taken away, but the government says, boss, I have the power under the Land Acquisition Act. I want to start a bullet train from here. I need this particular piece of land to either make a railway station or to set up the entire network of railway lines for the bullet train. In this particular case, the land is taken away. I'm using a word not used here, forcefully. They are not taking your permission. They are simply giving you a notice. Okay, we are giving you a 1 month, 3 months, 6 months notice that this land you have to leave your rights. Leave your rights means whatever occupation is there, you please remove it, because after this date we will take possession of this particular land. Yes, since this is a legal land, it is not atikraman. Hence, I will pay you. And that is where it has to be put in capital gains. That there is some flow of consideration, but the difference is it is not sale. It is not exchange. It is not a relinquishment. It is not extinguishment, because in all these things, it has to be from the side of the owner. Sale will be done. Exchange will be done. The sale exchange, in fact, requires both parties' consent. Relinquishment, extinguishment can be from one side, but that is from the side of the owner. Here, it is from the side of the person who is taking the land or taking that particular property. So first important thing is this is a unilateral act. First thing to be noted. Second point to be noted is this unilateral act will be covered under transfer only if it is powered or backed by some law. It can be any law. And third most important point, please pay attention, which I have found students making mistake in the exams. What it is? We presume that compulsory acquisition applies only when government takes your land. Is it written anywhere here? No. It is not written anywhere here. Means the land may be taken over by anyone. Compulsory acquisition can be done by anyone. So far as it is done under a law, powered by some law, as per the provisions of some law, it is compulsory acquisition. It is a legal, valid compulsory acquisition, and it will fall here. Please understand and appreciate this point. I have seen many times where we make a mistake in the question, whereby we presume that, okay, government is not given, na, some third person's name is given, it will not be covered. Sorry, that is not correct. I hope this point is also clear to everyone. Right, students? So please make note of these small pointers. At final level, these things will count in your different set of questions. Fine, students?
Yes, sir.
Yes, sir.
Excellent. Now, clause 4. Chalo, let us, instead of reading verbatim, let us directly discuss. Give me examples, students. What will be covered in clause 4? Chalo. You all may have also solved sums. Some may have kept this part in exception, in inter. Option means, ki chalo, will not study this.
Capital asset is converted into stock in trade.
Sir, that is verbatim. Explain me in a very lucid way. Rather, I'll say, give me a practical example.
Suppose if I have a building which I am living, and I also have a business of क्या बोलते हैं
Real
सेल्स भी
estate,
करता हूँ
dealing
बिल्डिंग
in.
रियल एस्टेट डीलिंग इन रियल एस्टेट तो
Hmm.
वो if I am converting that building into my taking into my business and making it into stock to sell it.
Sir,
So
so
at
this
a
is what
point
is
of
interesting to note. What this word means. Converting means आप उस पे क्या processing कर रहे हो? What you are doing to,
कैपिटल
so
एसेट
that I will understand you have converted.
कैपिटल एसेट को वो पर्सनल यूज के बिना बिजनेस में मैं लगा के स्टॉक के नीचे बेचने जा रहा हूँ.
Correct, sir. See, I hope you are understanding what is my question. Sir, I'm talking from a real life perspective. आपके पास बिल्डिंग है, करेक्ट? वो बिल्डिंग आपका कैपिटल असेट है, ठीक है? नाउ यू वांट टू फिट इन क्लॉज 4. तो आप ऐसा क्या करोगे कि पीपल विल कम टू नो, टैक्स अथॉरिटीज विल कम टू नो कि यू हैव कन्वर्टेड इट इनटू स्टॉक इन ट्रेड.
So it will be shown in the balance sheet, in the books of accounts, actually. In the books of
Let us
accounts.
say it is already shown, sir. It may be a business asset already. Correct, na? This land may be held as my, let us say, I'll give you an example. You had purchased a land for constructing your factory. So you have that land in your books of accounts. Now tell me whether it is capital asset or stock in trade.
Capital asset.
Agreed. Now I want to fit in this category. So what should I do so that I and everybody will understand I have converted and I'm fitting in clause 4? I do nothing. Simply while preparing balance sheet, what I was showing in the above part of the balance sheet where you write land building, I have removed it from there and I'm showing in the next section of the balance sheet, which is current assets. So we have different types of assets. We have fixed assets and current assets, or we have long-term assets and current assets. So until now, this particular asset was appearing in my above part of the balance sheet in the name of fixed asset or in the name of, as I said, what long-term asset. And now I have simply shifted it down and I am now calling it as land under current assets. That's it. So please understand, because tomorrow, as tax advisors, as consultants, when this will come to you, how you will match up or how you'll understand that this has happened. So you should know practically, because when we say conversion, like here, the word conversion treatment is used. So we visualize that conversion treatment means doing something on that asset. Nothing. Only in books it is done. Are you getting this point, students?
Yes.
Clear enough?
Clear.
Okay. Let us proceed further. Now, why this was introduced, let me tell you. This is again, you should know that why some special provisions are there, so that whenever a case comes, you are clear with that even further. So I'll again take a practical example. This you'll find everywhere. Now, in many cities, the land prices, especially land and immovable property prices, what was there 10 years before, has suddenly shot up and become 5 times, 10 times, somewhere 20 times. Correct? You all agree to that? I'm sure even in places where you all live, you'll find such areas where 10 years back in 2010, 12, 14, the property was very nominal value. In fact, nobody used to go to that place. Suddenly, certain things have started, some government projects have come. You find that it is boost. Now, I purchase a land in a area which is backward, which is not yet having much attention of public and government, when the value of that entire plot of land which I've purchased, let us say, is 1 CR. And it is my investment because I have no other thought process in mind. I have kept it as an investment. Investment means it is a capital asset. Now, in 10 years, suddenly because of some road coming up, some new government project coming up, some new announcements coming up that this will become industrial zone, whatever, the prices have gone up, and what was purchased by me for 1 crore today has become 100 crores. Now, please pay attention to understand what is the impact or why this point was here. Now, I am holding this for 1 crore. Today, I have a very good customer who is ready to buy it for 105 crores, 110 crores, because it has become a very cream property. It is the highway touch or road touch property. So it can be put to very great use. So I have many customers. Let us say the best price which I'm getting is 110 crores. Now, today, if I sell it, I'll have a huge capital gain because 110 minus 1 crore, my capital gain will be this much. For the time being, we keep indexation aside because anyways, you'll study now, indexation has been removed even for this immovable property, and there are some exceptions. So we keep indexation aside in our discussion. Anyways, in 10 years, indexation hardly has made it 2 or 3 times. So even if it index, it will be 3, 4, 5 crores, nothing more than that. Now, I come up with a brilliant plan. What? That this is my capital asset. I'm fitting in the chapter of capital gains because it is a capital asset. What if I change my chapter only? How I will change my chapter? When we read the definition of capital asset, you'll find that there are exceptions to capital asset, and one of the exceptions is stock in trade. So what if this asset is no more a capital asset? If this is a stock in trade, then what? And actually people started doing this. They started reclassifying the same asset. What they did simply in the books, what was shown in above part of the balance sheet, they put it in the lower part under current asset, saying that I have floated a new firm which will be into real estate business. And for that particular business, this will be a stock in trade because I'll be trading in real estate properties. So this is now stock in trade. Nothing has changed. The land, nothing has been done on that. Only in my books, I have changed the classification. Now, interestingly, there can be no tax. Why? Because there is no other party with whom I have done any transaction. Today, in my books, I have simply changed the classification from long-term or fixed asset to current assets. That's it. There is no person. Maybe I may not even sell it for further next 5 years. So there is no question on getting any amount, any income. But when I did this, what smartly I did, what was 1 crore, while shifting it to current assets, I took the current value, I showed 100 crores. And I can do that. You can revalue your assets and you make it 100 crores. Now, interesting students, this is not an asset for which you are going to claim depreciation, because if you were going to claim depreciation, revaluation was not allowed. But there is no such restriction in the PGBP chapter for stocks. So I revalued, means now interestingly understand this, your asset is changing the heads. What was till now classified under the head capital gain has now suddenly shifted and gone to PGBP. Because the moment you change from capital asset to stock in trade, the head has also changed. Now, henceforth, my asset will be classified in PGBP, and whatever I do of the asset will be treated in PGBP. So I simply changed the classification, and after 2 years, I sold the property for 110 crores. How much tax I'm paying? 110 minus 100. Because from the viewpoint of PGBP, the cost is 100. To counter such practices, they said, no problem. The moment you convert, there is a tax. So now this 1 crore to 100, which was going untaxed, will now be taxed because of this provision. And what is very special, there is no transaction today. In fact, in future, when you will sell it, when actually there will be transaction, nobody knows, but this is an income. That is the reason, that is the logic of including this or adding this here. This was introduced some 15 years back in the Act. Prior to that, if you go to older Acts, you will not find this clause there. Correct. Then comes maturity or redemption of zero coupon bonds. Again, certain companies issue these bonds. Now, there was a legal debate or dispute that whether maturity, that is when the period of the bond is over. Let us say you have taken a bond which is of 5 years. So when after the completion of 5 years, what will happen? You will return the bond and you'll get your money back. Now, the question was whether getting money back on maturity is any of this. What? Sale, exchange, relinquishment. Technically, no. There is no sale. You are getting your money back by giving away the bond, and it is not a sale. You have not sold to anybody else. You have given it back to the creator of the bond, that is the company. So there was a legal battle whether there is a sale, and the answer was there is no sale. So in order to still classify it in transfer and taxability, they have covered it here. Then comes the sixth clause, which says possession of immovable property. Now again, what this is, I'll tell you. Again, this has come out of a practical scenario. What is the practical scenario? Again, you'll find this very commonly in many of your surroundings. That I purchase, or I'll not say purchase, I booked a property in some new construction. Now this construction will be complete in next 2-3 years. I booked the ground floor shop. And I said, boss, now all the festivals are coming. I want to launch this shop on Dussehra. So the builder said, yes, my RCC work is done already. But even though my entire building, because it is a 25-story building, will be completed in 3, 4, 5 years. But what I can do is I can complete the brickwork, plaster, everything. And since it is ground floor, it will be usable immediately. You can launch this shop on this Dussehra. I said, fine. The price of that shop is 100 crores. I pay him 100 crores. He makes an agreement to sell. Why agreement to sell? He cannot make a sale deed legally because since the building is not complete, it is not having the completion certificate by the relevant authorities. Hence, it is not a finished product. It is not anything in existence legally. Hence, it cannot be sold because for sale, it has to be a present item. Now, this created some legal issues for the buyers. What type of legal issues? That today, if I am paying you the amount and you are giving me the possession of immovable property, I start enjoying the immovable property. But legally, I am not the owner. Now, what was found is many times either the builder runs away in between the project because he falls short of money, he's not able to complete, or the builder is unscrupulous. And what he did with you, he sold the shop to somebody else also. Because see, today there is no legal document except for that agreement to sell. So today you are not the legal owner of that shop. Now this created a lot of legal challenges. Hence, there was an amendment brought in section 53 of the Transfer of Properties Act, whereby it was said that when two things will be done. One, part performance is done. That is in terms of the consideration. You have made the payment of consideration. So from your side, you have done your part. And from the builder side or the owner side, what the builder owner has done, he has given you the possession. So when these two things are present, we will consider this, we will deem this to be a transfer, even though there is no legal document. Now, this particular point is an amendment of Transfer of Properties Act. And we are saying, boss, if Transfer of Properties Act consider it as deemed transfer, why not we? So we are saying if same thing happens in income tax also, we will consider it as deemed transfer. That is how clause 6 comes. Then comes clause 7. Again, this is a very beautiful provision. Again, it is coming out of a practical situation. I'll tell you what that practical situation is. In fact, it is covered in the example also given below. Today, you stay in a housing society. Many of you all, wherever you are staying, it is in some housing society. Best example I'll take, Gokuldham Housing Society. I'm sure many of you all would have watched Tarak Mehta. So in that, this Gokuldham Housing Society, you will see. So what is a housing society? Basically, it is a combination of multiple buildings or maybe even a single standalone building with many amenities, and entire thing is registered as a society. And since it is for residents, it is a housing society. Now, these acts, that is the acts made for these housing societies, say that the entire structure, the land, the building, the amenities, whatever, they are under the ownership of the society. Now you purchase a flat by paying 20 crores. Logically, you are the owner because you have paid for the flat, but technically, legally, the society is the owner. Let me tell you this. Then how can you be treated as owner? The answer is you have to purchase a share of that society. So the legal framework is like this. Let us say there are 50 flats, so there are 50 shares, not one more, not one less. And every flat owner is actually a shareholder of that society. And now pay attention, the flats are represented indirectly by the shares. Now what happens is, whenever you are transferring a flat, since you are not the legal owner, you cannot legally transfer. What you do is you actually transfer the share. And by transferring the share, you become the transferor of the flat indirectly. Because flat is under the ownership of the society. So you never become the owner of the flat. But because of purchase or sale of the share, you either by purchasing you become the owner, or by selling you part away, means you sell the shop, sell the flat. That is what is covered here in this transaction. What it says, transactions which have the effect of transferring or enabling the enjoyment of an immovable property. So here, what is that transaction? The transaction is selling a share. So it may appear to be only a 10 rupee share. But by doing this, what effectively is happening? They are transferring the entire flat. That type of transaction is covered in clause 7. So as you can see, the definition covers different case scenarios. I hope everybody understood all of these case scenarios. Anybody has any questions with this? Students, anybody any questions?
No, sir, it's very clear, sir.
Great. So when we are studying transfer, so see, we are studying these different topics. Now we are in transfer, defined under 247, which says transfer is what? Sale, exchange, relinquishment, all these things are of asset. Then you have extinguishment of rights, not of the asset, and so on. So you can note down all the clauses for your revision. But interesting, I just mentioned this head is an exceptional head. Whenever you study something, you have exception. So despite of all these being transfers, these are the different possible transactions that would be transfer. But we have many transactions which are not regarded as transfer. This is if you want to equate, you can equate it with Schedule 3 of the GST law, which says that transactions not to be regarded as supply. So what is the effect? That in all these cases, even though one of these things has happened, but the lawmaker have made a negative list because they do not want to tax it. So what they are doing, they are putting it in this negative list, which we call as no transfer. And for those transactions, even if it is sale, even if it is extinguishment, even if it is compulsory acquisition, whatever, there will be no tax, there will be no capital gain because it has been specifically put in the negative list, or in other words, it has been removed from the concept, from the definition of transfer. So now let us go to those transactions which will not be regarded as transfer. And I will request students that you all please prepare the chapter in this fashion only, so that when you are remembering, it will be easy to remember. And also when you are applying it for different scenarios, that will also be clear to you all. I hope this is very, very clear to everyone. Any questions, any doubts up to this point, students?
Sir, your approach makes us to in a understandable way. Thank you, sir.
Student, just give me a minute, please. Yes, Swaminathan, you were saying something. Sorry.
Sir, I'm saying that your approach is very clear and it's a very easy and easy to remember, and the relationship of this memory exception and transfer all these things no, at one place. It's very good, sir. That's what I'm saying.
Thank you. Thank you very much. So now, in order to completely understand the definition of transfer, we have to also understand what is not transfer. Now, what is not transfer is basically given in section 47 list, right? So section 47 has a big list of what is not transfer starting from here. However, many times we miss out on this, that there is also one case scenario regarded as not transfer, which is covered in section 46. What is that? Now it is in relation to liquidation. What it says, where the assets of a company are distributed to its shareholders on liquidation, such distribution shall not be regarded as transfer by the company. And it is specifically saying for the purpose of section 45. So first case scenario, which is regarded as not transfer, is section 46(1). This is by company to shareholders, and that also in liquidation. In relation to liquidation, whenever assets would be given away by a company to the shareholders, and I'm sure you all will agree to this, what will happen in liquidation when the company is winding up? It has to, now see, there are two possibilities. One, the company is selling the assets in the market, and the company is now whenever now at the time of liquidation, the first possibility is that the company is selling the assets in the market and then distributing money to the shareholders. That is not 46(1). That will be taxable because it is sale to outsiders. But what is envisaged in 46(1), students, be clear. Let us say the company is under liquidation. We have a shareholders meeting, and in shareholders meeting, I put across to the shareholders, see, we have this piece of land, we have this building, we have these multiple cars and trucks and all, we have this much of stock, we have this furniture, we have these many computers. Now today, if I sell it in market, you all will know second-hand assets will not fetch me any good price. And if I have to do a distress sell so that you can get free faster, even further, there will be reduction in price and it will ultimately lead to loss. Now, since we are limited 15, 20 of us, let us between us, depending upon our holdings, bifurcate who will take what asset. And people agree to this. So let us say it is so agreed that the company is not selling the assets in the market, rather it is giving away the asset to shareholders against their shareholdings. That case scenario is what is envisaged and covered under 46(1). And it is saying, now practically what is happening, if you have to look it from the point of view of 247, it is like an exchange. How company is giving away the asset and taking back the shares. So the shares, what it has given to the shareholders, that is taken back, that is dissolved. Means it is the shares are then obviously, since the company is now no more, the shares will be zero. But what has happened is company has given away the assets. Now you can also say it may not be exchanged properly because what it is getting back is not some asset. So you can also say that what the company has done is like relinquishment of asset, given away its assets, distributed its assets to the shareholders, and it is done at the time of liquidation. The law says we will not consider this relinquishment of asset as a transfer. There will be no tax. However, let me tell you, students, this is not covering the other side of the transaction. What is in this same transaction? If you look at from the shareholder side, what has happened? Shareholder has given away his shares, and in exchange, he has got the assets from the company. From shareholder side, there is a tax under 45(1) because shareholder side is covered in 46 bracket 2, and 46 bracket 2 considers this as a transfer. It is a variable transfer. Which one? Exchange. So the shareholder has given back or returned back the shares which he was holding, and against that he received, or in exchange he got the asset. So for him there is a transfer, there is taxability, which is under 46(2), which we will cover when we will deal with the taxability part. Right now we are understanding what is transfer, what is not. So first, what is not transfer is 46(1). Now we covered 47. In 47, we will study a list of multiple transactions where one of this thing has happened. But the law says, sorry, I don't want to tax it. For us, it is a negative list of transfer. We don't want to tax it. What are those? So let us now come to 47. So see, this is the first part, which is in the hands of the company. 46(1) applicable, it says no transfer, no tax. However, there is another side in the hands of shareholder where there is tax. How? That we'll discuss later when we come to the taxability part. Now, Acha. Another interesting thing. There is again a special section 46A. Again, we are not discussing it now because this section, which is a special case scenario that we'll discuss when we start the taxability part. Right now, I'm skipping 46A because I'm not going by the sequence of the act. I'm going by the sequence of the what we have created, transfer, not transfer, etc. So just even though I'm skipping, don't worry, this will be covered when we go to that particular section in our sequence. Now, we come to different case scenarios under section 47, which are to be regarded as not transfer. What are they? If you see clause 1, it is very similar to what we just saw in 46(1). What was 46(1)? Company giving away the assets to the shareholders at the time of liquidation. Similarly, 47 clause 1 covers a similar case scenario. Now it is an HUF, which is under partition. Now what will happen? We all are the co-partners. We all have some right in the joint property of the HUF. So what will happen today? Whatever is the asset, that will be distributed, divided between the co-partners. Now, similar to 46(1), 47 clause 1 says, if there is a distribution by the HUF to its members of any capital asset, and this distribution is on account of partition, which may be total or partial, we will consider it as not transfer. So similar to this, clause 1 is running parallel to this. HUF distributing assets to its members at the time of total or simple. No questions, no doubts. Now see, there is going to be a list of around 30 transactions. We will try to club it so that remembering them is easy. So both these two transactions, first two transactions are of similar nature. So you can remember it collectively. What? Company to shareholder on liquidation, HUF to member on partition. Both are exactly same. We can very well remember it easily. So you can club similar transactions to remember it conveniently. Now we proceed to further clauses. Now suddenly there is clause 3. What is missing? Clause 2. You know what was clause 2? Obviously, I'm using the word was because it is not presently here. Something similar to clause 1. You know what? It was distribution of assets by the partnership firm to its partners at the time of dissolution of firm. Now it has been removed. So it means that today, if there is a dissolution of a partnership firm and same thing happens, what does partnership firm says? Okay, you 5 are my partners. I have to pay back your capital and whatever balance is there in your capital account. And I have these assets. Again, if I go to sell it in the market, we may not fetch good amount. So instead, you mutually decide who will take the firm's building, who will take the motor car, who will take the furniture. And if people mutually agree, so what the firm does, it gives away the assets to the respective partners. That was 47 clause 2. Now, not part of the act, it has been omitted, which means that transaction is taxable, which we'll study later in section 45 bracket 5. And there are some other sides to this that we'll study. Sorry, 45 bracket 4, not 5, that is compulsory equation bracket 5. 45 bracket 4 is liquidation of firm, and that has a very different scenario now. So that we'll study separately. But just you should know that if 2 is not there, what was there in 2? Now we come to clause 3. Now clause 3 is actually covering a scenario of relinquishment of asset. So you are giving away your asset, and how you are giving it away? By one of these modes, by gifting it, or by creating a will, or by giving it away to a trust, that is like we donate to a trust. So any capital asset which is given away by way of gifting, or by way of making a will under a will, or by donating it to a trust, it is a relinquishment of asset. We don't want to tax it. However, what is there? From AY 24-25, transfer of capital asset other than shared debentures or warrants allotted by company under ESOPs, under a gift or a will or irrevocable trust by any person was not considered as transfer. Now, what is this point? This point they have clarified, because this point again has been removed. Up to AY 24-25, transfer of capital asset under gift will, under a gift or a will or irrevocable trust by any person was not considered as transfer. Now, what is the amendment? As you can see, now it is very specific. Only where the gift is made by individual HF, that is only what is not transfer. So anybody else making a gift will now be transfer. So up to AY 24-25, any person making gift was not transfer. Now from 25-26, you can say only where the gift is made by individual HF, that is only what is not transfer. So we can put the next clause here. So section 47(3), capital asset given away by way of gift, will, or irrevocable trust, but only by individual or HUF. So this is a simple clause, nothing great. Now next. Clause 4, clause 5 are again you can merge because they are complementary. It is what? A holding company is selling assets to its 100% subsidiary, or a 100% subsidiary is selling assets to its 100% holding. So firstly, there has to be a 100% holding subsidiary relationship. This is what is the requirement that you will come to know when you read this conditions. Now, if we are 100% holding subsidiary, understand the logic of both these clauses. Why it is not transfer? See, if let us say I am company A, you are company B, and you are my 100% subsidiary. If I sell any asset to you and earn any profit, it is profit earned by me only. And let us say if you are selling an asset and earning some profit, it is again profit earned by me, because whatever profit you earn or I earn, it is ultimately coming to the pocket of the same shareholders, because you are my 100% subsidiary. Understand the logic. So it is somewhere they are going by the logic of substance over form. If somebody is my 100% subsidiary, in the eyes of law, two companies are two separate persons, two separate assessees, but we cannot tax them. We do not want to tax them. Why? Because in substance, the transaction is nullity. Because it is like I earning from myself, and they don't want to tax it. Hence, to keep these companies' transactions outside, they have given this two reliefs. So clause 4, clause 5, what it says? Either by holding to subsidiary or by subsidiary to holding. If there is transfer of capital asset, transfer means it can be sale, relinquishment, whatever, it will not be regarded as transfer. What is the condition? The condition is, as I said, it should be 100% holding subsidiary that you get from the first condition. The parent company or nominee must hold the whole of the shares. The whole of the share capital of the subsidiary must be held. And second requirement is that the recipient should be, the transferee, not recipient. We are not in GST, sorry. The transferee should be an Indian company. Now here in this first transaction, Transfer is holding, transfer is subsidiary. So they are saying subsidiary should be Indian company. Here in this, transfer is subsidiary, holding is transferee. Here they are saying holding must be Indian company. So what it is saying? The transferee must be Indian company. So what are the conditions here? It should be 100% holding. And second, transferee is Indian company. No, Geet. Even if one share is held by somebody else, you will not get the benefit of this. So it has to be 100. 100 means all shares completely. Now, interestingly, there is a very interesting pointer here for which we have to deal with computations, which we will study in section 47A, 47 capital A later on. What it says, the exemption mentioned under these clauses will not apply if capital asset is transferred as stock in trade. Now, this is interesting, which means what? I am selling capital asset to you. It should be received as capital asset by you. Means what? In my books, this is capital asset. In your books, it should also be a capital asset. Why this point is given? Otherwise, they will try to take advantage of the same point. What? Asset converted into stock in trade. Now see, if you convert the asset into stock in trade, I will tax it. So you devise a new mechanism. Like you start a subsidiary, which is you only because it is 100% subsidiary. You show that you are selling the asset to that subsidiary, but you are not going to be taxed. Why? Because of this clause. But what the subsidiaries are real estate company. So somebody may find a way out and evade the tax. Hence, they have put this clause. The subsidiary should also treat it as capital asset. If the subsidiary is treating it as stock in trade, then we will tax it. Then this particular benefit of no transfer will go away. So I hope you understood why this condition is there. That for subsidiary also it should be a capital asset. For subsidiary, it should not be stock in trade. Students, I hope you understand the logic why this type of condition is there. See, we should not learn or simply remember the condition. We are at final level. We should be able to analyze what is the reason, what is the impact. Correct? Clear to everyone? The logics, the ideologies by which these provisions are made.
Yes, sir.
Now next many clauses, I will group it into one because they follow a common thread. Now, what are these further clauses? These further clauses are clause 6, 6A, 6AA, 6AB, 6B, 6C, 6CA, 6CB. All these I will group into one, rather CC and all. So all the C series you can say are grouped into one. Now it is interesting to note why they used clause C only to include all this. So they could have very well used any other clause, but they decided to use clause 6 only. And in 6, they brought all these things. Why? Because all these things have the same nature, same genre. What is this? Let me explain. Now, we have seen some of these case scenarios. Now I'll give you the next genre of case scenarios. What are they? To understand this, let us understand there is something called as amalgamation or there is something called as demerger. Now in amalgamation demerger, in the hands of company and in the hands of shareholders. Now in the hands of company, what is the transaction? You have an old company. Like in case of amalgamation, it is called as the amalgamating company. Under amalgamation, what happens? The old company sells or transfers all its capital asset to the new company. So in case of amalgamation, we'll say amalgamating company has sold or transferred all its capital asset to the amalgamated company. In case of demerger, we will say the demerging company has transferred all its asset, or the demerged company, sorry, has transferred all its asset to the resulting company. Correct? This is what happens in case of amalgamation demerger. Now, effectively, what is happening? Effectively, in the language of law, a proper sale is happening. So assets are sold, transferred by one company to another, which very well fits in 45(1)'s conditions. There is an asset which is transferred. However, the law wants to give benefits to business reconstruction. See, this is the reconstruction of business. The mergers, demergers. Now, there was a time when mergers, demergers were very difficult. But now, considering that you want to expand your business, you want to become multinational. So when we opened our economy to foreigners, or we allowed foreign businesses to come in, make investments, many mergers, demergers started happening. And even today, we are seeing mergers, demergers across the board. And that is how businesses grow. For making it smooth, you will find that all these transactions, which I am calling as business reconstruction or business reconstitutions, have been made tax-free. How they have made these transactions tax-free? They have made these transactions tax-free, firstly, by treating such transactions as not transfer. So, in case of a typical amalgamation demerger, what is happening? Old company giving away its assets to the new company. We don't want to tax it. We want to make all these business reconstitution, reconstruction transactions tax-free, tax neutral. Let me say, not tax-free, tax neutral. So that this is smooth. Any company can easily plan without having the headache of there being any tax implication. So they have said, boss, no transfer, no tax. Now, if you read these clauses, you will find that they have covered, one clause covers amalgamation of Indian company. One clause covers demerger of Indian companies. Then there is one clause covering amalgamation of foreign companies where they are giving benefit only on transfer of one asset. Then there is a clause which is covering demerger of foreign companies, again giving benefit only on transfer of one asset. Then you have one clause covering amalgamation or demerger of cooperative banks. You all would be knowing that there was a period when many cooperative banks got merged. Similarly, there is one clause dealing with reconstitution of banks. Now, these are other than cooperative banks. Now, what both these are, if you remember earlier, we had many cooperative banks known, very well known, doing good business, but suddenly there was a time that many of the cooperative banks started shutting down. Why? Because there were huge losses, something internal fraud happened, the directors, etc., siphoned off the bank deposits, and suddenly you started getting the news in many states that some very good renowned cooperative banks are closing down. So to revamp them, the government brought in this policy that instead of completely closing down, let us merge it with some other bank. Similarly, very good renowned banks other than cooperative, regular banks also, similar problems was there. So they started reconstituting it, whereby they were merged with some other bank. Again, in all this, what is happening? The old bank, which is getting reconstituted or merged, it is getting merged into a new bigger bank or an existing bank, which is much bigger, which can take over the banks. So all the, at least the deposit holders, etc., their money is not completely lost. At least they have a hope because now they become part of a bigger bank. So this particular category, which is amalgamation demerger, is covering so many individual clauses. I've already given you 6 of them. That is why you have so many clauses: 6, 6A, 6B, AB, BA, C, CCC, etc. Now, one impact of amalgamation demerger is on the company, where one company is selling off its assets to another company. And I've given you 6 case scenarios, so they have become 6 clauses. Now, at the same transaction, there is some impact on the shareholder. What is the impact on the shareholder? This shareholder is the shareholder of the old company, which is getting demerged or which is getting amalgamated. Now, what is happening? This shareholder is holding shares in old company, which it gives away, and in exchange, it gets shares in the new company. Correct, na? So what has happened? A shareholder of old company has old company shares. Under amalgamation, when the old company got merged with new company, what is happening in the hands of shareholders? It gives away the shares of old company, and in some predetermined ratio, it will receive the shares of the new company. So in the hands of shareholder, there is an exchange. Again, this exchange is not transfer. In what cases? Amalgamation of Indian company, demerger of Indian company, and in case of amalgamation, demerger, reconstitution of banks, both cooperative and regular. So this is how you find so many clauses coming up in this category. Now, if you have understood this, can someone read only the headers of this so that you'll come to know that whatever clauses or different scenarios I've explained, they are covered in different clauses. Yes. Somebody can read for me, please.
Sir, section 47, clause 6.
Clause 6.
Okay. Any transfer by the amalgamating company to the amalgamated company in a scheme of amalgamation.
So first is what? Any asset is sold by an old company to the new company, and the scheme is amalgamation. Correct? Second.
Yeah. 47, 6A. Any transfer by the amalgamating foreign company to the amalgamated foreign company in a scheme of amalgamation of two foreign companies.
So now this is the case of amalgamation of foreign companies. But if you remember, I had mentioned it is covering benefit only for one asset, not for all assets. Here, when it is amalgamation, demerger of Indian companies, benefit is for all asset. But where it is of foreign company, only one asset, which is given by old company to new company, is enjoying this benefit of no transfer, hence no tax. That is what is shares held in Indian company. So if one foreign company is merging with another foreign company and it is holding shares of some Indian company, obviously that share will be transferred by the old foreign company to the new foreign company. This one transfer will not be taxed. Correct? Fine. Go ahead, beta.
47, 6AA. Any transfer by a banking company to banking institution in a scheme of amalgamation of the banking company with the banking institution, sanctioned and brought into force by the central government under section 45, subsection 7 of the Banking Regulation Act 1949.
So this is what? This is amalgamation of banks. Correct? Next.
47, 6AB. Any transfer by the amalgamating foreign company to the amalgamated foreign company in a scheme of amalgamation of two foreign companies. And
So,
capital, yes.
Capital asset, please read.
Capital asset being share of a foreign company referred to in explanation 5 to section 9, subsection 1, clause 1, which derives directly or indirectly its value substantially from the share or shares of an Indian company.
What is this? It is saying transfer by the amalgamating foreign company to the amalgamated foreign company. So it is again what? Amalgamation of foreign companies. What is the underlying asset? Underlying asset is again only one asset. Now here it is the share of a foreign company. See, earlier here it was the share of Indian company, right? But now in the scheme of amalgamation of foreign companies, what they are transferring is they are transferring share of a foreign company. However, the share of foreign company such which derives directly indirectly its value from the share of Indian company. Now you'll ask, sir, what is this? So I'll give you a simple example. There is a foreign company which has invested all its money, let us say, in the share of Indian company. Now, if a foreign company has invested its money in the share of Indian company, what is happening is whatever is the value of that foreign company, the value is derived from the value of share of Indian company. If such a foreign company gets amalgamated, what it will do? In its asset, it is holding these shares, so it will be transferring these shares. So when such a foreign company share are transferred, but the share of that foreign company is having its value from an Indian company share, so that is also covered. So it is indirect substitute of this only, that where directly Indian company shares are transferred, that is not transfer, but where a foreign company is holding shares of Indian company and that foreign company share is held by some company and those companies are getting amalgamated, such benefit applies even to them because effectively it is nothing but replica of that. But what you have to keep in mind is in case of amalgamation of foreign companies, transfer of only one asset is not transfer, that is what is the shares. All other assets, if they are transferring, that is taxable. But in case of amalgamation demerger of Indian companies, all assets transferred are not taxable. Now here up till now, we were only dealing with amalgamations. Now we will get the series of demergers. Please go ahead.
47(6)(b). Any transfer in a demerger by the demerged company to the resulting company, any capital asset, the resulting company should be an Indian company.
Same. So now we were dealing with amalgamation. Now it is demerger. Again in demerger, whatever assets are transferred by the old, that is the demerged company, to the new, that is the resulting company, all will be not taxable if that is demerger relating to Indian companies. Second,
47(6)(c). Any transfer by the demerged foreign company to the resulting foreign company in a scheme of demerger of a foreign company.
but here again only one asset transfer is not transfer. All other assets, if transferred under a demerger of foreign company, they would be taxed. Correct?
Capital 47(6)(ca). Any transfer by the predecessor cooperative bank to the successor cooperative bank or to the converted banking company in a business reorganization of cooperative bank, any capital asset.
Read next also.
47(6)(cb). Any transfer by a shareholder of predecessor cooperative bank in a business reorganization.
Okay, fine. Sorry, this is the shareholder category. Now, so we are in the demerger category. So in demerger, firstly of Indian company, then of foreign company, and then of banks. So in case of banks also, wherever there is reorganization, whereby, as I explained, the old cooperative bank is get merged with some other cooperative bank, that is also not taxable. That is what is covered in CA. Now, up till now, we were covering this. What we were covering, we were dealing with the company part, where new company were there and there were transferring shares and all these cases are covered, right? Now we are going on to the impact of shareholders, correct? Now we come on to the second part of this same genre, that is what is the impact on the shareholders. Now in the hands of shareholder, there is an exchange. They give away old company or old bank shares, and in exchange, they get the shares of new company or new bank. That will again not be taxed. And again, here all these scenarios will be covered. First scenario is of bank. So this scenario is what? Transfer by shareholder of the old bank in a business of reorganization. Now, what he is transferring is the share of the old bank, and what he will be getting in exchange is the share of the new bank. So that you can see here, what is the capital asset? Being the shares held by him in the old bank. And in this, what will happen? He will be allotted shares in the new bank. So this is what is the obviously an impact in case of amalgamation demerger. What is the impact on shareholders? It will be this only. And this is what is again made not taxable. So when amalgamation demerger benefit is given to company, same has to be extended to shareholder so that nobody is taxed. For everybody, it is a tax neutral scenario. Please read.
47(6)(cc). Any transfer by the demerged foreign company to the resulting foreign company in a scheme of demerger of a foreign company. Capital asset being a share of a foreign company referred to in explanation 5 to section 9 subsection 1 clause 1, which derives directly or indirectly its value substantially from the share or shares of an Indian company.
Next.
47(6)(d). Any transfer or issue of shares by the resulting company in a scheme of demerger to the shareholder of the demerged company.
Again,
Cap-
here what demerger is happening of companies, the impact on the shareholder. Old shareholder giving old share, getting new share. And next, clause 7.
Yeah, clause 7 is any transfer by a shareholder of amalgamating company in a scheme of amalgamation of companies.
Now,
Cap-
this is what, in case of amalgamation of company, impact on the shareholder. So, for this shareholder, there are three possibilities: amalgamation of Indian company, impact on the shareholder; demerger of Indian company, impact on the shareholder; and reconstitution of banks, impact on the shareholder. So, I hope you understood this whole category. So, there could be multiple clauses. Now, these clauses are ranging from clause 6 to clause 7, and in between, you have all A, B, C, D, etc. clauses. Correct? I hope this is clear. So you can write down all the clauses, but these clauses are basically covering only two categories of transaction: one in the hands of company, one in the hands of shareholder, and only in relation to amalgamation demerger. So this is whole, let us say whatever 10, 12 clauses we discussed, they basically only deal with this much. Correct, students? Any questions or doubts till this point? Students, please respond.
No, sir.
So even though we are reading so many provisions, I'm sure it will be now easy for you to remember them because I'm categorizing it, I'm classifying it to make it easier. In fact, if you would have read these clauses, you would have not got a link. Now, first I explained you what this category belongs to. Now, when we are reading the transaction, it is simple, right? Now, let us have a 10 minutes break. After break, we come back and deal with the other provisions, right?
Right, sir. Thank you.
Okay. Now, please read this for me. Neha. Neha, who was reading? I think Neha was reading. No?
Yes, sir. Yes.
Yeah.
47 7A. Any transfer by a non-resident to another non-resident outside India, capital asset being bonds or global depository receipts referred to in section 115 AC1.
Okay. Now, what is this? Now, our Indian companies, when they want to raise money in foreign markets, directly issuing shares in foreign markets may have different challenges. The biggest challenge is of foreign currency. So what they do is they convert their shares into bonds or GDRs, which are, you can say, such type of securities which are denominated in foreign currencies. So now, if any foreigner wants to invest in the shares of Indian companies, that is done indirectly by purchasing these GDRs or ADRs. Now, in order that these non-residents do not have any tax implication when in future they sell off these assets, this particular clause was inserted, which says that if one non-resident is selling off, transferring to another non-resident what? These GDR receipts which are referred in 115 AC. So this is simply to enable our Indian companies to raise finance through foreign markets. And for the foreigners who are investing in Indian market, it should be a tax neutral so that it becomes an indirect incentive for them to purchase these bonds. Next. Neha.
Sorry, I was on mute.
No problem.
47 7AA. Any transfer made outside India by a non-resident to another non-resident. Capital asset being a rupee denominated bond of an Indian company issued outside India.
So similar to GDRs, we have another concept, rupee denominated bonds. Next.
47 7AB. Any transfer of specified capital asset by a non-resident on a recognized stock exchange located in any international financial services center. Capital asset being a bond of GDR referred to in section 115 AC, subsection 1, or a rupee denominated bond of an Indian company or a derivative or any other security notified by the central government.
Now, we all know that this is a new concept called as International Financial Service Center. Anybody knows where it is?
In Gujarat?
Yes. What is the name?
Gift City?
Yes, they have named it as Gift City. So it is developed on parallel lines of Singapore, where Singapore is, you all would be knowing, it is a one of the hubs for this international financial service centers. Now they want India also to have a parallel mechanism. So they have developed this place called as Gift City in Gujarat. And it is largely promoted by government. And we'll see many things relating to that coming up here and there, even in news. Now, in order to make that particular investment lucrative, what it is saying that again, where any specified capital asset, what is the specified capital asset, any one of them, is transferred by a non-resident on a recognized stock exchange, which is in the gift city. So if any non-resident comes and makes investment in any of these assets, and these investments are listed in the recognized stock exchange, which is in the gift city, then any transfer of such shares through the gift city international recognized stock exchange will be a tax-free transaction. So basically, you'll see that these three transactions which we just saw are benefits for non-resident. In this last one is specifically relating to where you have done the investment in the gift city. So for promoting investments by non-residents in our Indian assets, they have brought these clauses. So next three clauses are: first, non-resident to non-resident Second, non-resident to non-residents. This is GDRs, and this is rupee denominated bonds. And then non-resident transferring specified capital asset. You have a list in gift city. So these are the three clauses, all giving benefit to non-residents so that they make investment in our Indian companies, so that our Indian companies get benefit of raising foreign finance. Now, why we promote this? One, because it infuses funds in our Indian markets, foreign funds. And second, you would be knowing that foreigners are also keen in investing in our market or parking their money in India, because India gives higher rate of return as compared to foreign sources. So even foreigners are interested in that. And for us also, as compared to the bank loan rate, if a Indian company goes to foreign market and offers them even 70-80% of the bank loan rate, they are happy because they are getting much higher rate on return. And we are happy, our Indian companies are happy because they are getting funds at a cheaper rate. So it is a win-win condition. But in order to make it lucrative, it is equally important that whenever these foreigners, they transfer their assets, for them the transfer in future should be tax free. Then only today they will make investment. Hence these three provisions. Next.
47.7 AC. Any transfer in a relocation of a capital asset by the original fund to the resulting fund.
Next.
47.7 AD. Any transfer by a shareholder or unit holder or interest holder of original fund in a relocation of fund.
Now, what is this? If I have to give you example, again, both these are together because both these are of similar genre. What is that? See, I'll give you an example parallel to this, which is easy to understand. You have made investments in a mutual fund units. Now, originally the mutual fund scheme was a debt-driven mutual fund scheme. Now, today you find that many mutual funds, or let me say, firstly, originally many mutual funds, when they launched their scheme, that was a single scheme. That okay, if it is a debt-oriented mutual fund, your money will be parked in debts only, or if it is a equity-oriented, it will be parked in equity-oriented only. But later on, you'll find that now many companies are coming up with such type of schemes where they are allowing you to switch to another category, or they themselves are switching their original fund from one category to another. Now, in such cases, what they do is, let us say their original fund was equity oriented fund, and there is another fund that is debt oriented fund, and they are giving you option. If you want, you can switch from this fund to this fund. Now, effectively, what is happening, if you see on paper, you give away the units of this original fund and you get the units of the new fund. Now, technically, it is exchange of an asset, which is the units. To make such shifting between these funds tax-free, these two clauses have been introduced. So, first is transfer in relocation of a capital asset by the original fund to resulting fund. This is where the mutual fund do it at their end. Second, transfer by a shareholder or unit holder or interest holder of original fund in a relocation fund, where you are given the option and you want to switch. So both scenarios are covered, where the mutual fund itself is changing its fund, or second, where you, who was the shareholder, unit holder of that mutual fund, you are switching your units from one fund to another. Both these are made tax-free transactions. Correct? Please read.
47.7 Any transfer by India Infrastructure Finance Company Limited to an institution established for financing the infrastructure and development.
Next.
47.7 AF. Any transfer by a public sector company to another public sector company notified by the central government for this purpose, or to the central government or to a state government.
Now, again, if you see both these things, see, these are what? See the last column also, the condition column. The institution should be set up under the Act. The transfer should be under a plan approved by the government. And what are these transfers? Transferred by India Infrastructure Finance Company, short form is IIFC, to an institution established for financing. So basically what has happened, originally you can say this was some type of a private company. Later on the government felt that let me make a government company. So they made it in the form of, they launched a new government company. Now they are saying that the assets of this company will be taken over by the government company. So that type of transfer by this original company to the new institution, which is established by the government only, as you can see from the condition, then this is like a compulsory merger. You don't have a choice. Now the government do not want private players to be there, so they have merged these into government institutions. Or second, transfer by a public sector company to another public sector company. So already you are a government company, but again the government has made up some plan of merger of one public sector with another. So under that merger, the assets are being transferred. So again, in both these, it is a way of merger, but as per the government plans or the government schemes. That is what is covered. Next.
47(7)(b). Any transfer of a capital asset made outside India by a non-resident to another non-resident. Capital asset being a government security carrying a periodic payment of interest.
Now, this is also of this genre that one non-resident is transferring to another non-resident, but what it is government security. Correct? That is what is this point. All these are of same genre, so I've written them together. They are all non-resident to non-resident or by non-resident and of some specified assets. And again, you can understand from the names of these assets, these are the assets in which the government wants to promote foreign investments. So they are making the further transfer of these assets by the non-resident tax-free by putting them in non-transfer. Read the next one.
47(7)(c). Any transfer by way of redemption by an individual. Capital asset being sovereign gold bond issued by the RBI under the Sovereign Gold Bond Scheme 2015.
Now, if you remember, this was a scheme launched by the government where the government say, as Indians, you all are having this special love, special soft corner for gold. But since you all invest in physical gold, it puts a lot of pressure on the country as a whole because majority of this gold has to be imported because India is not producing so much of gold. Though now in past few months we have got news that there are some gold reserves found somewhere, but that will take time. So for the time being, India is a very big importer, like how we import crude oil and all. We are also a big importer of gold, and it puts a lot of pressure on the government because then again, all foreign relations, geopolitics, everything comes into the picture, plus foreign currency, all things come into the picture. So the government came up with this concept that if your interest is only in the investment, and that is what is a typical Indian mentality, that why we buy gold, because it is imbibed in our genetics that gold, land, these are some investments which always gives return in long term. So it is a typical, you can say, tradition also in many of our families and culture that on specific days or on specific muhurats, we buy gold. So the government said that let us do the same thing, but instead of you buying physical gold, you buy our gold bonds. Now the advantage is this is pegged. Pegged means this is linked to the gold prices. So today, if let us say you invest 1 lakh in these bonds, I will convert it into grams of gold. Let us say whatever is the equivalent grams of gold. I will give you the bond for that many grams of gold, or other way around. Let us say it is a 10-gram sovereign gold bond. Then I'll tell you what is the today's market value. You pay that much. So you indirectly, instead of buying the 10 grams of gold, you buy the bond. Now let us say after 2 years, 4 years, whenever you will be selling these bonds, then we will be giving you back the gold prices of that date. So what was your original interest of investing in gold, that is satisfied. So the government brought this concept that instead of you buying physical gold, invest in our sovereign gold bonds. But here this no transfer will apply, not when you're selling it in open market, but when it is being redeemed. So obviously redeemed by whom? Redeemed by the government itself. That is where RBI has issued. If the RBI is redeeming the gold bonds, that redemption is not transfer. Correct? Then comes the next part. Please read this.
47(7)(d). Any transfer of a capital asset. Capital asset being conversion of gold into electronic gold receipt issued by a vault manager, or conversion of electronic gold receipts into gold.
Now, what is this? Now, this is interesting part. It is, you can say, linked with the above point. What is this point? Capital asset being what? Conversion of gold into electronic gold receipt issued by a vault manager, or conversion of electric gold receipt into gold. What is this? Again, the government said, like how we have converted physical shares to demat. Why not you convert your physical gold to electronic gold? How? You give us the physical gold, we will issue you a receipt which will show that, boss, now your, like your demat account holds so many shares, your electronic gold bond, you can say, not bond, like account, let us say, is holding so much grams of gold. So indirectly we are converting your physical gold to electronic gold, like how we converted your shares to electronic shares, which is the demat shares. So government said that, okay, stop holding physical gold for all safety reasons. Also, best, whatever physical gold you have, let me convert it into an electronic gold receipt. So again, it is indirectly an exchange. You are giving physical gold and getting something else, but that is not transfer. It is not transfer on either side. Either you convert gold into receipt or you convert receipt into gold, because that facility is given that tomorrow when you actually want gold, then you can come back to us, give the receipt, we'll give you back the gold. So above point of sovereign gold bonds and this point, all these things were introduced by the government to reduce burden on the physical gold requirement, so that less gold had to be imported. So both these are on the similar lines. Now this clause 9, why it is, if you would be knowing that there is a lot of demand for Indian artifacts, for some very age-old manuscript, for some very age-old murti, or some painting or drawing. Now, government found that people are illegally selling it outside India, and many times because of that, what could be our national heritage is going outside. Like a few years back, I got this message that Gandhiji's original specs, Gandhiji's some original belongings like his lathi and all, they were auctioned in some foreign market. Same thing is something of Swami Vivekananda ji was auctioned in some foreign markets. Now these things are our national heritage. We will not like these things going out of India. So government brought this concept that you want to sell it. Now do one thing, you sell it to us. So what you are doing, you are transferring any of these things, work of art, archaeological collection, book, manuscript, etc. To whom? To either government or to our national museum, university, art gallery, etc., etc. So the purpose is that since these are of our national importance, these are our national heritage, at least you sell it to government. Anyways, you want money, I'm giving you money. But the best part is these things will then be with the government and it will not go out of the country. So transferring such things to government or national museum, etc., will be tax free because it will be no transfer. Please read next one.
4710. Any transfer by way of conversion of bonds or debentures, debenture, stock, or deposit certificates in any form of a company into shares or debentures of that company.
Next.
4710A. Any transfer by way of conversion of bonds into shares or debentures of any company.
What are these? Now, these are typical accounting transactions you would have studied in company accounts. What is the first transaction? Originally, the company gave you bonds or debentures with a condition or with a pointer that after 5 years, we will convert it into shares. The bonds will get, or the debentures will get converted into shares, or the bonds will get converted into debentures, whatever. So effectively, it is an exchange. You are presently holding a bond. You give us the bond, you will get debenture. You are presently holding a debenture. You give us debenture, you will get the bond. So effectively, what we are doing, we are converting. Sorry, we are converting your present this asset into some other asset. Now, all these things you have studied in company accounts. We used to pass journal entries for that in the books of the company. But in the hands of the shareholder, this falls in the category of exchange, which we do not want to tax. Hence, it has been put in not transfer. Similarly, conversion of bonds into shares or debentures of company is not transfer. Similarly, conversion of preference shares into equity shares is not transfer. So all these three are of similar lines. Conversion of asset from one form to another, from bonds to debentures, debentures to shares, or preference shares to equity shares. All these will not be regarded as transfer. We don't want to tax this because effectively no income or no profit has arisen. Only the form of the asset has changed and we don't want to tax it. But technically, since this was falling in transfer, it could have attracted tax liability. But to clarify it that we don't want to tax it, they have removed it by putting it in the list of not transfer. Then this very old clause 12 was that where there is a sick industrial unit. Now, in order to come out of sickness, what the industry will do, they may be transferring their land, they may be selling the land. So to give them a relief, they say that if a sick industry is transferring its land, and the purpose is obviously to come out of sickness so that at least it will get some cash infusion with which the company can start functioning. So if it is transferring its land, the transfer of such land is not taxable. We don't want to tax it. Then comes this very interesting category. Please read, Bada.
47.13. Transfer of a capital asset or intangible asset by a firm to a company on succession of the firm by a company in the business carried on by the firm. Transfer of a capital asset by AOP or BOI to company consequent to demutualization or
Corporatization.
corporatization of a recognized stock exchange in India.
Perfect. Now, what is this? Now, we had a category of this, right? Amalgamation, demerger. Similarly, over here itself, I'm writing business reorganization. What is this? We have different ways of reorganizing. Maybe you can call it as reconstitution of business, correct? Now, what is this? We all have again seen this in accounts. A proprietorship converting to company. A partnership firm converting to company. Correct? An unlisted company converting to LLP. Now, all these are forms of business reorganization, business reconstitution. In this, what happens? Old, I will now use the word person, is selling off, is transferring all his assets to a new person. And the purpose is reorganizing or reconstituting the business. So a proprietor becoming company, a firm becoming company, or a company who does not want the hassles of all the compliances of a company is converting to LLP. Now, in all these cases, again, what happens is effectively, which you have done even in accounts whenever you have solved these sums on this, we show that the old person, whoever it is selling off its assets to the new person, or selling off the net worth of that entire business to the new person and getting some purchase consideration. We have solved so many sums in accounts. We have done valuation, we have done goodwill, so many things. Now, this is again a sale of an asset. The asset is the whole business, a business as a whole, or the assets of the business. We don't want to tax it. So all these things have been treated as not transfer. Now, in this comes a very interesting scenario, which is where you will see AOP, and they have used the word corporatization of stock exchange or demutualization of AOP stock exchange. Now, what is this? Earlier, our stock exchanges, BSE, NSE, mainly BSE, when they started as group of people coming together, meeting under a tree. Today, where the stock market building stands. Earlier, there was a street, which is today also called as Dalal Street. I'm talking about some 50 years back. And on a specific day, let us say a Wednesday or a Friday of a month, these people from different parts of India would come there, they would meet, and they would exchange. Exchange means trade in the shares that they are having. Because at that time in India, companies were limited and nobody knew the concept of sale of shares and all. But few people who were very visionaries, they thought that even we can deal in the shares of companies. And from there, the concept of stock exchange started, but it started as a group of persons. And once this stock exchange started growing, there was a period, if I'm not wrong, somewhere in the year 2000, when the government ordered that these all stock exchange have to compulsorily become a company. So today you have BSC Limited, NSC Limited, means they have been converted into a corporate structure. This is what is called as demutualization. So what was a mutual AOP is now demutualized, or it is also called as corporatization of stock exchange. So what was not a company has been made a company. So all these are also cases of corporatization. So when you convert a non-corporate entity into corporate, it is called as corporatization. Here it is corporatization of stock exchange. Again, in all these things, what is happening? The old stock exchange, which was in the form of AOP, has sold off all its assets to the new stock exchange, which is in the form of a company. And this sale, this transfer is not regarded as transfer, just to give them the benefit of conversion. Similarly, what is happening? You were the member of this old AOP stock exchange. Now, in the hands of member, what has happened? He has given away his membership rights, which he was holding in this old AOP. And in exchange, he has got shares in the new stock exchange, which is a company. So in the hands of member, same like what we discussed for amalgamation here, in the hands of shareholder, what has happened? Old shares given, new shares received. Similarly, in the hands of members of this old stock exchange, he was a member. So he was holding a membership right in the old stock exchange. Now, because of conversion of stock exchange, what has happened? He has exchanged this membership right against the shares in the new stock exchange. So again, in the hands of both the stock exchange, there is no transfer of this on this conversion, and in the hands of members today, whom we call as the share broker, we have this Share Khan, we have the Asit Mehta and Company, we have the you have all these stock brokers or stock market agents under whom we have to register and we can do share trading. So we are not doing share trading; only they are doing share trading on our behalf. So today also the rule is if anybody of us wants to trade in the stock exchange, we have to open an account with these stock brokers because they are only having the right to trade. So that is how this has come up. So in the hands of the stock brokers, they surrendered their membership right and they in exchange got the shares. Again, this exchange was not regarded as transfer. So this is what is the first point is about the conversion of firm into company or conversion of this AOP stock exchange into company stock exchange. And the second is on the hands of the member, where he gave away the membership right in the stock exchange against the shares in the new stock exchange. And it was all under the scheme of demutualization of stock exchange or corporatization of stock exchange. Correct? Then this is what transfer of capital asset, where a private company or an unlisted company converted into LLP, and similarly the effect of on the shareholders. What has happened? The transfer of shares held in the company by the shareholder against what? Against his rights in the LLP. So when company is converting from company to LLP, one effect is in the hands of company and second effect is in the hands of shareholder. Both are not transfer, not taxable. Similarly, in case of conversion of proprietor into a company, again, there is a transfer of asset by proprietor to company, no transfer, no tax. So all these case scenarios, proprietor to company, firm to company, unlisted company, or private company to LLP, demutualization of stock exchange or corporatization of stock exchange, and again, the effect of all this on the members or shareholders. Everything not transfer, not taxable, just to make all these business reorganizations tax-free, tax neutral. Correct? Just give me a minute, please. Now, some more simple transactions. Transfer in a scheme of lending of securities. This has been made non-taxable. Transfer of capital asset in the scheme of reverse mortgage. Transfer of capital asset by a business trust who is actually nothing but it is a share of a special purpose vehicle, and transfer by a unit holder in consolidation scheme of mutual funds. If you remember above also there was a mutual fund example where they are shifting your units from one scheme to another. Here they are consolidating. So what happened originally when these mutual funds started, they started with small schemes. Now they have hundreds of schemes which becomes unmanageable. So now what they did, they started merging the schemes into one common scheme. So this is what is consolidation of mutual funds. Then transfer of unit holder in the consolidation plan of mutual funds, similar point. So you will see that these are some transactions, specific transactions which have been regarded as not transfer, not taxable. So students, I hope you understood all these scenarios. These were all diversified scenarios. I tried to group them so that remembering them is easy. I've listed down on the notepad all the key transactions, the important ones, which are having more probability of having any questions in the exams, but you have multiple other transactions. Is this clear to all? Students, anybody has any questions on this? Whatever we discussed today in the entire class. Perfect.
Yes, sir. Clear, sir.
Excellent. So I stop over here. Now you will be having a MCQ session. So I'll just stop sharing my screen. Yes. So firstly, thank you from my side. We connect again next week. And in that we discuss the other components of our uh, this chapter, that is what is capital asset, types of capital asset, etc. So thank you, students. Thank you all. Good night. Let us catch up again. And you will be there in this session for this MCQ part. Thank you. Thank you very much.
So, student, these are the four questions which you have done are the MCQ question for the for today. So, I'm can ending the assessment. So, Chitra has answered all the questions correctly. So, thank you guys for joining the class. हाँ जी, yes.